Natural gas futures dipped as traders reacted to a combination of bearish weather revisions and lingering inventory pressure. Updated forecasts over the weekend now call for more moderate temperatures across the key demand regions of the U.S., especially the East Coast and Midwest. Instead of widespread 80s and 90s, the pattern has shifted towards showers in 70s to 80s, effectively curbing expectations for strong cooling demand in the coming weeks. This softening in the weather outlook compounds the pressure from robust production and elevated storage levels. U.S. dry gas output remains strong at around 107.4 billion cubic feet per day, nearly 4% above last year's levels, while demand remains relatively sluggish, averaging between 74 and 77 billion cubic feet per day. LNG exports have picked up modestly to 15.4 billion cubic feet per day, but that increase is not enough to fully offset the daily surplus of supply over domestic consumption. Additionally, the latest EIA storage data showed bearish injections of 96 and 55 billion cubic feet over the last 2 weeks, keeping inventories roughly 6.2% above the 5-year average. And more importantly, the surplus is set to keep growing, with the next 4 storage reports expected to come in above average. These fundamental conditions continue to weigh on prices and limit the ability of the market to sustain rallies. That said, there are growing signs of potential reversal risk. Traders are increasingly alert to any short-term weather volatility or production hiccups that could tighten the balance unexpectedly. A sudden return of hotter-than-normal forecasts, or even localized heat waves in high-demand areas, could quickly shift sentiment. Likewise, any disruption to production or LNG flows would narrow the surplus and offer price support. From a technical perspective, natural gas briefly broke below last week's support near $3.30, finding buyers at $3.40. A return above $3.30 would be an early sign that dip buying is building. The more significant bullish trigger lies at $3.57. A decisive break above that level could pave the way for a run toward the resistance levels clustered around $3.75 pivot. Until then, the market remains biased to the downside unless a credible catalyst emerges. Please like, subscribe, and comment to support the channel. See you in the next one.